So that's all right. But this is just a list of some, not all, of legislation done in the last 10 years only. And so it's ever changing legislation. Some of the big ones is this one up here, the Tax Cuts and Jobs Act of 2017. Has anybody ever heard of that? That's good. Most people have maybe heard about it, but we forget about it and then move on. I'll reference back to that quite a bit because when we're talking about tax planning, it needs to be mentioned. But you also see, this was 2017, and these have all been since then. Secure Act, these are huge things that have happened in the tax world. That was 2019. No, most people don't even know this happened 2019 because it passed in December, like 29th of 2019. And then what happened beginning of 2020? COVID. And so this just went under the radar. And then you had COVID, the CARES Act come into play, still dealing with some stuff in there. And then they decided, hey, let's do Secure Act 2.0 too. So it's just like all this stuff has been continuing to go. Main thing about the Tax Jobs and Cuts Act, like I said, I'll reference back to it a couple times, is it had ongoing change for businesses, but we're not talking about businesses. We're talking about individuals right now. And it started in beginning of 2018, and it's going to technically end in 2026. So some of the rules are going to revert to what they were before the Tax Jobs and Cuts Act of 2017. And that's going to happen in 2026 unless more legislation comes through. So again, we'll kind of come back to that a little bit more. But I'm going to kind of hammer through some of these basics of tax planning so that, again, we're all on the same page. And this is in our normal lives, I'd say pre-retirement and retirement. But when we're asking the question, how will our retirement income be taxed? We're really looking at two things that are going to be taxed. Or the government is, I should say. The government looks at, one, what type of income you have coming in. Is it ordinary income? So we'll look at that. I'll dive deeper in that in 1 second. Or is it capital gains or qualified dividends income? That's income coming in the door. Then it looks at the other thing is what type of account you might have, like an investment account or retirement account that can kick out income. But that, depending on how that account is kind of structured, will depend on how it's taxed. And so there's IRAs, 401ks, Roth accounts, annuities, health savings accounts, and these other things called tax-free bonds. But I'm not going to get too much into these later, but they're still a part of the tax kind of conversation. So let's dive into ordinary income. What is ordinary income? And this is the majority of what you're all taxed on every day while you're working, pre-retirement, but it's also what's going to be taxed mostly in retirement as well. But basically, it's your wages, interest. This is going to be a big one this year. If anybody's taking advantage of like money markets are paying interest finally in the last 20 years. That interest is going to be ordinary income. It's not going to be dividend interest. It's actually, or dividend capital gains or anything like that. If people have rental units, royalties, maybe side business income, if you had a great day at Potawatomi and gambling winnings. So, and then eventually we're going to talk about a portion of your Social Security can be taxed as well. But your ordinary income is going to be taxed on what are called 7 different marginal tax brackets. We are in a marginal tax bracket system here in the US. And what this graph shows is basically pre-tax cuts and job acts on the right, actually, so the darker blue, and the current system we're in, the Tax Jobs and Cuts Act. I know I'm going to mess that up here in a little bit. I always do. It starts to ramble together the more you say it. But in the lighter blue, that's I'm sorry, I missaid that, didn't I? The lighter blue is what we're going to fall into after 2026. Right now, we are in the darker blue. We're in a lower tax bracket system. So the Tax Jobs and Cuts Act has lowered all the tax brackets, all but 2, as you see right here. And after 2026, what I'm showing you here is that we'll revert to this higher level. Does that make sense to everybody? I kind of showed you the wrong color at first. So here I just want to demystify or maybe debunk some of this marginal tax bracket world we live in. A lot of times people come into my door and say, I'm just getting killed in taxes. I'm in the 22% tax bracket. And most people honestly think that, okay, if I'm in the 22% tax bracket or I don't want to go up into the next tax bracket, they think that all my income is going to be taxed at that level. That's not the case. You're shaking your head correctly. Marginal tax bracket system means, if I pick on the single tax filer here, it just means that this is literally from the IRS website. It says that the first 11 grand you make is going to be taxed at 10%. Then the next roughly 30 plus grand you make is going to be taxed at 12%. The next, between 44 and 95 grand you make is going to be 22%, and so on and so forth. That's the marginal tax bracket that the system we live in. The more money you make, the more that extra money gets taxed more. So we're all pretty similar in the lower brackets. The more kind of, I'd say maybe a better way to think about taxes, especially going into retirement planning, is going to be looking at what's called your effective tax rate. Pretty simple idea. It just takes the total tax you pay. So you do a little math and you divide that by your taxable income. So if I have an example here of a single filer who makes 50 grand, if they were under the assumption that I just mentioned, they would say, hey, I'm going to look at my little box here. I'm going to be in the 22% tax bracket because I make 50 grand. So 50 grand is more than 44 and less than 95, right? That's how a lot of people think of the tax bracket code, but that's not true. So if we break it down or look under the hood, you got to do the math. So the first 11 grand of this person's income is going to be at 10%. Here's the math. The next, 30-ish grand is going to be at 12%. Here's the math for that, for total taxes. And they'll have a little remaining left in the 22% tax bracket. So not a lot is being taxed in the 22% bracket for this individual. But if you add that all together, they are going to pay $6,317 of taxes. So to kind of take this full circle, if we're looking at our effective tax rate, which is total tax divided by your income, this person's in a 12.6% effective tax rate. Not nearly as bad as maybe they think. I like to just overlay the tax brackets on a graph visually because two things pop out right here, right? I know I have arrows out there already, but it's just showing you where the big jumps are. So we start at 10% and go to 12, not a big jump. The biggest jump is right here from 12% to 22%. Most married filing joint couples will be in this bracket if you're both working somewhat. The next bracket is at 24 to 32%. So if you have couples that are making decent amount of money, only takes a little over 150 grand each, which can be done these days in certain households, then that puts you up into those higher brackets where, some more tax planning needs to be done. Okay, so we talked about ordinary income. That's, what I'm getting paid. There's another type of income called long-term capital gains or just capital gains. There's two types of capital gains, short-term and long-term. And how this gets triggered, again, I know some of this might be a review for some people, but this is when you own an investment. It's triggered, the tax is triggered when you sell an investment. So if I owned Apple or Google stock, and then I sell that stock for either a gain, let's say, then I'm going to trigger the capital gains tax. And which one I fall under, long-term or short-term, as the name kind of sounds, is going to depend on how long I held that stock or how long I held that investment. And if I held it for under a year, that gain that I made is going to fall onto my ordinary income schedule I just talked about. So if I had simple math, 5 grand in Apple stock, I held it for 6 months, I sold it for 15 grand. Great, I made a profit. So I had 10 grand of profit. That gain is going to be added as just normal income coming in the door. It's going to fall in those tax brackets that I just talked about. But if I held it for a year, over a year, the government encourages that for investment, they're going to tax you at lower rates. And that's what's called long-term capital gains. And so long-term capital gains can be either 0, 15, or 20%. So the IRS, as you'll see, I know I'm talking fast through this, but the IRS loves to throw different schedules at you. They love to do that. So this is long-term capital gains. And to kind of jump ahead, long-term capital gains just cares about your taxable income. And however much you make is going to say how much your capital gains are going to be. So if you're married filing joint and you have taxable income of under $89,000, which is actually a pretty good number, you're not going to pay any capital gains tax, 0%. Most people, the government's not stupid. They understand their limits. Most people will fall into this category of their capital gains will be about 15%. So let me just go to I call it my chalkboard. I just kind of pop out here. Let's just do a little review. Talked about gross income, ordinary income. I'm talking about taxable income now. So capital gains looks at taxable income. So all taxable income is, you don't need to know all the little things here. It's just taking a look at some of your adjustments as well, some of your deductions. So that's even better, is how I would take that. Questions on that so far? Anybody? Feel free to ask. Let me get back up. Okay. Right. There we go. Okay, so just say that again. Taxable income, however much taxable income you have, you're going to fall on this schedule. And most people are going to pay 15% in capital gains tax. And just as
89, that's not your adjusted gross income. That's your net after all the deductions.
Yes, correct. Yep, your tax.
$90,000, 10,000 into an IRA is actually
Correct. Yep. Mm-hmm.
Standard deduction.
Yep, standard deduction. Correct. This was changed in the tax jobs cuts and acts. Like I said, I know you say it 100 times, your brain goes loony, but before that act, it was just whatever marginal tax rate you hit. So if you hit the marginal tax rate, like those ones I just talked about, you hit the 22% rate, for example, that's how they scheduled it. You'd be in the 15%. Now they moved it to taxable income. So it could revert back in 2026 if they don't change. And so this just overlays both tax kind of schedules on one page here, pointing out that for married filing joint, that 89 grand is kind of the magic number that all the taxes start to kind of come into play. But what this is showing is that definitely capital gains tax, if you can get even in zero, is more beneficial than income tax, ordinary income. 401ks and IRAs, just to touch base on these, most people have 401ks and IRAs. Main thing to understand about these, we're talking pre-tax 401ks, pre-tax IRAs, especially in the 401ks. I know you can have Roth 401ks, but let's just, in this scope, talk about pre-tax 401ks. You put that money in pre-tax. So if you put in 10 grand in your example, the government, and you make 90 grand, the government sees that you're going to be taxed at 80 grand because they're taking that off your taxable income. Then it grows tax deferred. And you don't pay taxes as you go, but once you retire and take money out, it's going to be taxed at that ordinary income rate that we just described. 59 and a half is the magic age that the government kind of says you're retirement eligible. You can start to take money out of your retirement accounts at that age. Anything under that age, they penalize you 10%. There's my ticker. I took that away for, yep, that's right. Good, yeah. That's right. And on top of, correct. Yep, it's on top of this. So they add whatever your ordinary income is plus 10%.
If you're under 59 and a half, you could approach 40 to 50%.
Yep. At least. Yep, exactly. We're going to talk about this later too. Pre-tax IRAs and 401ks are subject to required minimum distributions. And we won't talk about that. Now, Roths are fantastic accounts. They work the opposite, again, to make sure we're on the same page. The money goes into these accounts taxed. So in that example, if you make 90 grand, you put 10 grand into a Roth, the government still sees you make 90 grand for taxable income. However, that money grows tax-free, and then you can take it out in retirement tax-free as well. So a huge benefit to a Roth. One's not better than the other. Some people always ask me, what's better than the other? One's not better than the other. There's just pros and cons to each. But in general, the Roth does have some good pros if you can, wait a while and have time on your side. You only have to hold the account for 5 years. After the age of 59 and a half, that same rule says you can take everything out tax-free. If you are under the age of 59 and a half, they will penalize you on that, any gain. You can always take out your contributions, but any gain on the account, they'll penalize you. This is a big one. Just put this in your memory for a minute too. Roth IRAs do not have required minimum distributions. So that's a big pro. In the sake of time, I'm going to skip past this one, and I want to talk about health savings accounts. I love health savings accounts, so they made the list here and talking about tax. Anybody use a health savings account? Okay, perfect. So that's great. And just to summarize, some people call it a super Roth, or you get the triple tax benefit. The triple tax benefit is, money goes in tax deferred, tax deferred. Money can grow in the investments tax free. And then just like the Roth, you can take the money out tax free if you use qualified medical expenses. So that's the normal use of HSA. And you're going to have health expenses in retirement, so we know that. But there is this cool provision that not a lot of people understand, is that it's an age 65. It's a random age. It's a little bit older than that 59 and a half thing we were just talking about. But age 65, it basically takes away the penalty. So if you use an HSA for age 65 on anything other than medical expenses, they're going to penalize you 20%. So it's one of the biggest penalties they have. But over 65, that penalty goes away. You can use this money for anything you want. If you use it for anything other than medical expenses, you have to pay tax on it, but you don't get penalized. So essentially it just becomes like another IRA. I love having eject buttons on things, so that's what I kind of call it. All right, so I'm going to take a breather. Anybody watch The Office? Michael Scott. All right. Any questions on that? I know I flew through that, but okay. So summarize. I just had to lay the groundwork for everyone on the ways things get taxed. There's the income and capital gains tax. Then there's the types of accounts you have out there that can tax you differently as well. So let's move into Social Security. I think this is the meat and potatoes of the presentation, what people need to understand about Social Security, because it can get a little complicated. Main reason is because the IRS throws something else at you. They say, hey, we just talked about ordinary income. We just talked about qualified dividends. We have all those schedules. Now we're going to throw in something else called combined income. So combined income is just another calculation for your income that the government's going to then look at your Social Security. So I'm going to talk about how that works here in the next slide. But overall, and we had a Social Security presentation before this 2 weeks ago. And during those presentations, I always ask, or I get the same response, I should say. It's a very split response. When I ask, do people think Social Security is taxed, or, a lot of people fall in the bucket of, if they're not into this stuff, that, they're very surprised that Social Security is taxed at all. There's those people. The other people are just very surprised that it's not taxed as much as they think. And so it literally lands right in the middle. So depending on where your income levels fall, so just like we've been discussing, if your combined income is under 25 grand as a single filer, you don't pay any social tax on your Social Security. If you're between 25 and 34 grand, up to 50% of your Social Security can become taxable. And I'll explain this in a second. And if you're over 34 grand as a single and over 44 grand as a married joint filer, up to 85% of it could be counted as taxable, but not all of it. So that's the good thing. So let's look at how combined. Correct. Yep. Just kind of gets added back into it. Yes. And here's how they do that. So they take your adjusted gross income. They add back any what's called tax exempt interest, which might mean if you had any like muni bonds or something. Those interests on like muni bonds are tax free. Then they add in 50% of your Social Security to come up with your combined income. So just hit the pause button. Let me go back to my little blackboard here. We're talking about adjusted gross income right here. So we're kind of in the middle of this little table. Take our gross income, add in any adjustments that might be over here. Now in retirement, you're not going to have a bunch of like IRA contributions or anything like that. So you're not going to have a ton of adjustments, but they still might be some out there. And so then they use adjusted gross income. Okay, so let me go back. We'll recap that real quick. Oh, I was only one slide away. Easy. So adjusted gross income plus tax exempt interest plus 50% of your income, and you land in your combined income. And going back here, wherever that combined income falls, we'll either add in your Social Security. So let me give you maybe a real world example of this. I'll do the real chalkboard example. We have some notes that I just kind of thought of this morning, but let's say that we have a person who is, or let's do a married couple. They have an adjusted gross income of $30,000. Okay, 30 grand. Actually, let's use 32 because that's what my notes say. I don't want to mess up my math being live. So 32 grand. They have Social Security of 30 grand between the two of them. Okay. I'm going to say they have no muni bonds out there. So no, interest they have to add back. So if I want to look at combined income, I'm trying to find combined income. I'm going to do that calculation. I'm going to take my adjusted gross income, which is 32,000. I'm going to add any interest. I don't have any because that's more common. And then I'm going to add my 50% of Social Security. So if I just do that over here, 50% of Social Security of 30,000 is 15 grand. I have terrible handwriting, guys. I apologize. But if you're with me, so we're adding 32 grand of AGI, zero interest income, and then we're adding 50% of our Social Security, we are going to get a combined income of 47 grand. So if we go back to our tables, which I can actually do here, 47 grand as a married filing joint, where do they fall? Anybody want to say what percentage of their Social Security? Married filing joint, their combined income is 47 grand. 47 is higher than 44, right? So up to 85% of their Social Security can be taxed. So what's going to happen then if I go back to my example? 47 grand. So we got that number. That's their combined income. So then we take 85% of our Social Security, which is 30 grand. 85% of that, that's a times, is like 25 grand, 25,500 or something. So that's going to be added back into your income numbers, that ordinary income numbers. It's not going to be the total tax you pay on it, because then you still have to go through those, these things like the deductions and any credits or taxes already paid. So it might not be the total amount you pay, but it's going to, eventually land. It's going to be included in where you land on those tax brackets. Okay, let me take a breather for a second. Any questions on that?
In your either practice or your experience, do most people have their Social Security taxed if they have some kind of job in retirement, say a part-time job, just doing something fun? And
yeah, most people
will have some portion of it.
Yes, most people will fall. These limits aren't very big. So yes, most people will have a portion of their Social Security tax. Now, it doesn't mean, like I said, it doesn't mean that all of it's going to be taxed. It all kind of comes out in the wash. But I would assume if you have anything else going on between pensions, IRAs, maybe working part-time, it's just going to have some of your Social Security that's going to be taxed. Okay, one more just kind of example to illustrate this, and then we'll keep moving on. Is this couple? We're gonna kind of compare couple one and couple two. They each make the same amount of money, 67 grand. Both have interest income of CDs, 5 grand. Both have dividend income of 10 grand. Tax-free bond interest, each have 5 grand. The only difference is right here. That couple one is taking 25 grand out of their IRAs to live. Couple two is taking 25 grand out of their Roth IRAs to live. So this is just illustrating, if you keep adding, that gets added in as income, add in their Social Security, they do that calculation for combined income. their combined income is going to be 56 grand, which is going to make up to 85% of your Social Security taxable, compared to Roth doesn't get added in as income. So these people don't have any Social Security. So what you can take away from this is just, it's good that you're here. And if you don't have Social Security turned on, and there's things that we'll talk about in a second. So like having some money in different buckets as you go to eventually get retired can help you be flexible at times like this. So which buckets do we take income from, and for how long is a lot of what we talk about in kind of real world financial planning. And then just really quickly, you saw these in some of the last presentations. To throw another bracket at you that the government and IRS loves to throw at you. This one's called the IRMA bracket, and this is for Medicare. So Medicare premiums are tied to income too. So just another little thing, a variable, if you will, that you have to watch out for. Things like Roth conversions or something that I'll talk about could screw this up. I've seen that before. But the more money you make in retirement as well could make your Medicare Part B premiums be higher. So everybody at the age 65 can go on Medicare, and their Part B comes directly off of your Social Security. Part B is $164.90 a month. It comes right off your Social Security statement. Now, if you are in these higher brackets, so I'm just picking on joint, if you're in the 109, these are bigger brackets, which is good. But if you make more than 194,000 as a married filing joint, your Part B premium goes up to $230 a month. So everything's kind of connected in the tax world. What's weird about IRMA is it looks back 2 years. So it does take some planning. So it looks at your tax return from 2 years ago when you're retired and applies your IRMA for that year. You can argue with them on that, but I've never seen anybody do it very well. So this, just since we're on it, not to dive too deep on it, this is adjusted income, or a form of adjusted income called modified adjusted income. So think of it basically as that adjusted gross income we talked about. They just add back one more thing, which is like those bond. Oh, I even have it here. So it's your adjusted gross income, and they add back any tax exempt interest if you have any of that. So that's like the muni bonds. So I have that in there just in your packets for reference. Okay, I'm a big Netflix TV show fan, so if anybody watched Narcos, that's this. But it's tax. It's tough to talk about. Any questions? So I'll take a little breather on Social Security.
So it looks at the prior 2 years. Does that keep happening each year?
Correct. Yep.
So if you're making less as time goes by, it can go back down?
Yes, correct. The main thing I usually see this get triggered when people don't know about it is usually the Roth conversions. And I'll talk about Roth maybe at the end here, but Roth conversions, people love them at times. They are great, but they have to be used correctly. But some people just be like, hey, let's do some Roth conversions, and I'll pay the tax now and leave it to my kids later. Very noble, whatever. But what they'll do is then when you do a Roth conversion, you're taking IRA money, pre-tax, taxing it now, it becomes a Roth. So you're paying ordinary income tax on it. So it just gets added on top of everything else you've done. So some people will do 100 grand or something. They'll convert 100 grand of IRA money to Roth, and that makes their IRMA brackets just get exploded. And so, they might have not even known about that. And then 2 years later, they get their Medicare Part B coming off their Social Security at almost double. They're like, what the heck happened? So, but they'll only be for 1 year if they don't do it again. Yep. But then it'd be 2 years that they'd then have the IRMA kick in.
So it's 2 years after you do it.
Mm-hmm. Yeah, it's kind of a look back. Correct.
Third year will be back to.
Yeah, if you correct. Okay, so in our last 17, 18 minutes here, just some things to think about in proactive tax planning. It's not a static game, right? Everything is always changing in tax planning specifically. So you can always do some things to be proactive in your situation. Everybody's different. The more things you have going on too, the more flexible you can be. But things to consider is, like we talked about last session, when to claim Social Security. What else do you have going on? What other buckets of money can you draw from, and all that? That's a big tax consideration. When to take Social Security, and all that. It's not only tax, but it's I kind of call it a personal situation too, as well. And then there's some deductions that you can play with. There's sources of income, sources of and timing of which buckets to take from. Those are things you have to look at. Roth conversions, and then last one I'm going to end on is RMDs. Actually, I don't have it in here either. RMDs, and then inheriting money, inheriting IRA. So just really quickly on deductions. Some of you, I think, mentioned this earlier. There's a standard deduction now that got pretty much doubled from that Jobs Tax and Cuts Act of 2017. But you still can itemize or standard deduct. So most people don't itemize anymore because the standard deduction is $27,000+ for a married couple and over $13,000 for a single filer. So that's usually well above what anybody has, especially in retirement. But what some retirees do is like they call it like bundling. You can do like a bundle, and that's basically taking 2 years of deductions you might do, like whether that's charitable deductions, big ones like health insurance stuff, like maybe you have some procedures done right away together. You can do some state and local tax prepay stuff, but basically you just try to get all of your deductions done in 1 year for kind of 2 years. You can kind of prepay for 2 years, and that might be more than your standard deduction. And then you kind of do that on a every 2 year cycle. So every 2 years, you're getting more than the standard deduction. Takes some work, and not everyone's gonna have big medical expenses all the time, but maybe. If you want to take the extra, look at it, it can happen. But at the same time, it's harder to itemize because they limited some mortgage deduction and state and local tax too. So, all right, RMDs. RMDs changed in 2019 and then again last year in those acts that are called the Secure Act. So anybody know what an RMD is? Just so I don't have to. There you go.
Government wants their tax money.
Exactly. So most people still think, if they don't know these rules, they've heard of 70 and a half. That was for a long time the age in which you had to start taking required minimum distributions, which, like you eloquently said, is the government wants to start taxing your IRAs and 401ks. Now the rule has changed to kind of my cheat sheet here. You can figure out when you start required minimum distributions based on what year you were born. So if you're between 1951 and 1959, your RMD is at age 73 starting. And if you're after 1960, it's age 75. My take on this is it didn't change the actual rates. It just changed the age that you had to start taking it. So there's really no like material impact to people on this. Like, sure, you can defer your money for another year or two that maybe you didn't have to, or that you would have had to take it before this rule has changed. But in essence, if you think about it, at age 73, you have to take out about 3.8% of all of your accounts, or your retirement accounts. And that goes up every year. It's called the lifetime table. Don't quote me on these numbers here. I'm just writing them on how it looks. So these still don't change. So if at 73 was 3.8, at 75, it's still going to be 3.95. So you maybe got a year or two of quote unquote not having to take it, but it's not going to change things much. Questions on that at all?
Qualified charitable deductions at the same age limits?
Good question. Actually, at charitable donations can start at 70 and a half. Yeah. Really good question.
What was the question?
Yeah, so he's talking about charitable donations. You can get a deduction for taking your IRA and distributing it directly to a charity. It's called yep. It has to go right to them directly. And you can start to do that as early as age 70 and a half. So essentially what it's doing is it's satisfying your RMD. Government says, okay, great, you took your RMD. but you're not getting taxed on it either.
So it does count towards the IRS.
Correct. Yes. And that's usually what people do with it, or usually when it's being used. Okay, so here's just the recap on Roth conversions. I've mentioned it a few times. So again, it's not like recommendations or anything. It's just something to look at. Everyone's different on timing. Sometimes when I see they're really a good thing to think about doing is maybe somebody retires early. You don't need to take income from Social Security or pensions or whatever. So maybe in that next year, they're not going to have any reportable income coming in the door. So maybe they can do a Roth conversion at that time. That's a good, easy thing to do, a Roth conversion, because then, it's just like maybe working for another year. They convert whatever amount that might have been to keep them in the tax bracket they want. That's when maybe you see it in real life. But there's pros and cons to it. The pros are all the advantages of a Roth. When you take money out of them in future, they're tax free. You don't have to take RMDs out of them. That's fantastic. Tax rate hedge. Some people just think that the government's going to have higher taxes in the future, so they want to pay all the tax now, and when that's going to be the lowest that they think it's going to be. Estate planning, it is better to pass on Roths than traditional IRAs, which I'll touch on. Then it just gives you some flexibility. But the cons are paying the tax bill now. That's where I mentioned earlier people can get in trouble. And this gets a little granular, where if you convert $100,000, you kind of want to be able to pay the tax from other money, because that's coming from invested money. If you want to keep it invested, you don't want to, take half of it, pay the tax. Now you only have 50 grand. It's like, well, why did we do that? That's not good planning. So now that's a big example, but just giving you a thought, high level on, you should probably pay the taxes from a different source. If it's a new Roth, like you don't have one existing, the 5-year rule comes into play, meaning you have to kind of get all the benefits of a Roth, tax-free distributions, et cetera. You have to have it for 5 years.
You, looking at the tax table here, if you converted a portion of a Roth, say you have $100,000 in a traditional IRA 401k. If you only converted, say, 80,000 the year you retired, for whatever reason you decide not to work at all that year, you would be taxed at 12% for most of it.
Yes, exactly. And that's a good way to think about it. That's what most people would do, is that's how, you don't do all of it all at once. It's more portion. The best way to do Roth conversions is to kind of do them over time. When you're retired, if you really want to get that, maybe you have a big IRA bucket that you're not going to be using and you want to pass on. You want to take smaller portions of it, fill up those tax brackets like you're kind of describing, to not push you into the higher one, put you in fill up this bracket that you're comfortable with, and do that over a course of a handful of years. That's a good way to get money from traditional to Roth.
Is there an income limit? So if you meet a certain threshold that you can't do so much of?
I don't think so. Somebody asked me that last time, and it made me double think that, but I don't think there is. Not to my knowledge.
I heard this is.
Yeah. Oh, yeah. Yeah, I'll double check. I don't know every little tax rule, but in my planning, it's never come up. But the fact that a couple of people have asked that now maybe makes me think I'll double check and I'll get back to you. But I've never before today would have said completely no. Yeah. Yeah.
Maybe that's what they're thinking.
Yeah. That's probably what you're thinking. Yeah. Now that you say that. Yeah. There is limits on contributing to a Roth IRA. Yeah, I guess thinking through it more, the government on what we're talking about, converting, the governments love Roths and they're pushing them. That these last, Secure Act rules are definitely opening their chest, that they love Roths because they generate revenue. So, I couldn't think that there would be an income limit from my knowledge. So I'll stand firm on that. The last couple, pros and cons on the con side are the opposite of the tax rate hedge. Potentially tax rates could go lower. Technically they did in 2017. The Medicare increase thing we just mentioned, and market timing can be an issue too. So if you do big portions, market timing comes more into play. If you do the smaller portions, it doesn't. Okay, I think this is about it, and then we'll open it up for questions. So one of the biggest rules and changes over the last few years is for inheriting IRAs. So we're talking about taxes in retirement, but I bring this up here because it can come into play when people are retired. They might inherit an IRA now. So that's gonna, be something you have to deal with. Or if you want to talk, or think in the future of giving away IRAs to kids or what have you, some of that thinking has to be changed because in the old law, it was very beneficial. If I inherited an IRA, then I just had to pay those RMDs based off my age. So if I was younger and inherited an IRA, I had to pay a smaller percentage for my whole life. And so if I'm 40 and my rate's only like not even 2% that I take out each year, that's going to make that account last quite a long time. So that was great. And unfortunately that went away. So you can't do the stretch IRAs anymore. It now moved to this 10-year rule. Anybody heard of this rule? And so the 10-year rule came out recently. It's still a little gray area. The IRS isn't very concrete on how it works, but how it first came out, easy to understand, is that they got rid of the stretch RMD rules. It just came to more down to the individual to plan, and it just had to be exhausted by the 10th year, meaning you had to take out the money from the inherited IRA, pay your tax on it by the 10th year. They didn't care when you did it. Could have been first year, could have been evenly over the 10 years, or it could have been all at the 10th year, but you had to do it. Now, the general rule, understanding of the rule is you should still take required distributions, but you still have to have it exhausted, taken out / taxed by the 10th year. A lot more restrictive. There are some, designated beneficiaries that can still kind of go into that old stretch IRA rule, but we won't get into that for now. So overall, kind of leave you with that. Is tax planning takes a lot, retirement planning takes a lot. There's a lot of intricacies in taxes, but use your tax advisor, do it yourself. Hopefully you understand. I'd say the biggest takeaway today is the Social Security stuff. That's what I really want people to know about taxes in retirement, is how your Social Security is taxed. But it is affected by all those other things going on. You can work with other advisors. Hope you do. Give you the chance to, if you want to do a review with me, but don't procrastinate. Failure to plan is a bad plan. And as a reminder, please fill out those evaluations for me if you don't mind. You don't have to check yes or no. I'm not going to hound you for doing a meeting, if you don't want to, but some of those other questions do help me give some feedback to them here and myself. But if you do want to do a consultation, we'll do a financial plan for you if you want. Our financial planning software is called eMoney. It's some of the best planning software in financial planning on the street. It does a lot of cash flow, retirement stuff, but it has all the tax stuff in there too. So it'll really help you, do some scenarios of, should you do a Roth conversion here? Or if I take Social Security here or there, how does that impact my tax situation? Oh, it's just a picture of some of the reports. Usually these meetings take place over 2 different meetings. First meeting is just that. First meeting, we get to know each other, understand your goals. If you have any just main questions, we can tackle that. If that's all you want to do, that's fine. If you do want to do the second, or the financial plan, that'll come in the second meeting. I'll go back, our team will do our homework and create a plan for you. And then we'll give you that plan in the second meeting. And from there, you can take it or leave it, any recommendations that might come. There's never any hard sells or obligations in our world. We wouldn't be invited back to these types of places if we did that. Our goal is to, there's, like when we do these in companies, benefits aren't the only, the end all be all for people's financial picture. And we know for in front of enough people, there'll be stuff for us too. But hopefully take some confusion out of today. Stop using your neighbors or what your friend said should be the right thing to do. My brother-in-law said to do this. I get that all the time. All this, just some more stuff. So that's all I have for you today. Thank you for your time. Any questions, I'll kind of stay online and I'll be here for a little bit. Okay, I'm actually gonna stop doing that.